Hello, everyone. This is Terry with Futures.io, and as always, I would like to thank you for joining us today. It's my pleasure to welcome back Morad Askar, aka FuturesTrader71, for today's Ask Me Anything webinar. As this is an AMA, throughout the webinar, if you have a question, please remember to type them into the questions box. We'll do our best to answer them throughout the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. We're trading news, events, and information. Follow us on Facebook, YouTube, and Twitter using @FuturesIO. Please bear with us due to the COVID-19 pandemic. Most of us are working from home, so you may hear children or small animals in the background. And now, without further delay, I will hand it over to FT71, and you'll get the pop-up to share your screen. You're still muted. I'll do.
Very cool. I'm assuming everyone is seeing the slide. This is just contact information. This is an open AMA, so nothing was prepared. I'm ready to answer whatever question you throw at me to the best of my ability. I'm at your disposal for the next hour or so, so let me know what you're struggling with or what you would like to know.
I'll throw the first question out there. What do you make of today's action, the big sell-off?
I know many people watch the Trader Bite I do every morning, and it's a live stream on YouTube available to the public at 9 a.m. every day. And there were signs that I discussed earlier in the week, Monday, Tuesday especially, to say that this thing, man, it's giving me signs that it's starting to get toppy. And it's just, we're in that kind of market that just likes to give you a run for your money, and then it finally let go. Now, I covered some of this morning, and I said that what led me to believe that a correction is not a correction, but at least a reversal is on the way, is because the structure we had created underneath us over the last, at least month and a half or so, from the drop that got us down into 2100 in the S&Ps, the structure on the way up is very, very poor. I mean, we didn't properly auction all the way through some of these levels. We've got about 4 gaps. When you look at the pit session only, we've got 4 gaps on the way up, and we hadn't done the classic, consolidate, push up, consolidate. The consolidation is really important, and then push up, consolidate, push up, consolidate. We've done push up, pull back, push up, push up, pull back, push up, and it just is really fueled by just a flood of money coming into the market. And it's great for everyone's stock portfolios. And again, our economy is 65% based on the stock market, and so the stock market has to go up. But today is quite exaggerated. We've crossed almost 200 handles in the S&P in just about 2 trading sessions, with a massive gap. We gapped down today through an area that we gapped up through before. Just very erratic, very I don't know how to describe it. You know what it reminds me of? It reminds me of May 2007, that time where we had this kind of strong move up through the housing bubble, and then May had this big drop, and then the market came back up, and everybody's like, oh my God, we're gonna push new all-time highs. A year goes by, and then Lehman Brothers, Bear Stearns, the rest of the story, it just completely collapsed on itself. That kind of behavior, it's just everywhere you look around, and anybody you ask will give you that, scratching their goatee or beard look of, I don't really understand this. And what that leads to is just a poor auction, and a poor auction is a house of cards. It just tends to kind of fall on itself. But trend day down. Once we broke out of balance this morning and started pushing through 3077 in the S&P, and I'm quoting September. I rolled to September already. Today's the official roll day to September for U.S. indices. once it broke through that 30.77, there's really no excuse to get long. There were a couple of rotations that looked like good scalp longs, but they didn't hold very well. So I don't know what to tell you more than that, but structurally, looks like we're in repair mode now.
Okay. I've also made you an organizer so you can see the questions as well.
Okay, cool. Let me pull that up.
In the coming days, will you use point of control and gap locations from the September contract in the ES?
Yes. You know, my software backward adjusts the data, so the data is still good. It's still using the volume profiles and everything from the March contract, but it adjusts the prices. Those prices, it should have adjusted the prices down 10.5 points. That's the premium for today's roll. For this roll, it's 10.5 points in the S&Ps, and so those numbers are valid. So I'll be using those, the same gaps and everything else, but adjusted for September prices.
Okay. When you ran a prop firm, was there any statistics you looked at in terms of trade performance, and were there any thresholds or targets you look for?
Yeah, I'm very statistically based. Historical probability is very, very important to me, and I created a tool that was run on an Excel sheet that was tied into the traders trading platform. We used XTrader Pro at the time by Trading Technologies, and we would get the fills every day, and it was all performance based. I mean, that's where the idea behind the trade analyzer came, and you know, creating something more robust than that now. But it's all, you know, if you're running a shop, look, you don't have to run a prop shop even as an individual. You should be all about trader performance. You should be all about your performance. And it's not P&L. Like, I didn't track P&L. P&L tracked itself. The statements came in every night. And at the end of the month, or sometimes in the middle of a good month, I would go through the statements and balance things out and pull money out of the clearing account and pay everybody out, so we don't have a lot of money sitting around. But at the end of the day, we track performance looking at things like you know, expectancy, which is built on the win and loss percent, the average win, average loss. We looked at what percent of trades had a full stop. We looked at how long winners are being held, how long losses are being held, what size winner versus what size loss. We looked at risk factors. We looked at activity, time of day performance, day of week performance, day of month performance, tied it to trading calendars. You know, are you good at FOMC or should you stay away? Am I saving money by sending you to the movies on non-farm payrolls or FOMC day? So there is a lot of that. And for any trader listening, you know, you should be tracking performance. I know it's an AMA and you're asking me questions, but let me ask each one of you here. I guess there's a whole lot of you here, but let me ask you, who here, honestly, I don't know who you are, but who here is not keeping a trading log, meaning some kind of an accounting or a spreadsheet or something that is tracking your daily performance and computing at least your win percent, maybe your expectancy or some sort of metric that's important to you. I'm not going to dictate what's important to you. Who here is not doing that? Well, who here is doing that? Is everybody here doing that? Say yes if you are. Type Y or something in the thing in front of you. Chat. So quite a few of you look like you are. If you're not doing it, so keep responding. Good. So if you're not doing it, it is going to be very hard for you to get back on track. So no matter who you are, I mean, Terry may have been trading for the last 10 years. I don't know. I've talked to Terry now for at least 5 or 6 years, but Terry might have been trading for the last 10 years. You'd think that Terry doesn't need any of this stuff. He's a veteran now, and it doesn't really matter for him. Actually, it does, because every single one of us is having to deal with constant change and a change in market regime. And with a change of market regime, you're going to take a drawdown. Drawdowns are normal. Losing streaks are normal. And it's that log that is the tool that helps you determine what is you just screwing up versus just a normal drawdown. It's there to track what your performance is. And it's that trade log connected with a journal that helps us go back to the mindset that we need to be in. So for example, I don't know how many traders have done this, but I know many, and most are, they do all this homework, a lot of charting, a lot of indicators, a lot of, they attend webinars, they sign up for this course and that chat room and whatnot, until they start to make money. And then if they start to make money, the first thing that happens is they stop doing those things that led them to make money. And the best part about a trade log in a journal that's maintained through the period where you are up to and where you are making money is when you're off the reservation and you're starting to put on size and you're starting to now scalp and double down and do all these crazy things that cause people to have a massive drawdown after making this progress, is that trade log helps you see and reminds you, even gives you the feeling of what it was like when things are working. I want to go back to a period where I was making money. So I'll look through the trade log and see, whoa, look at this. This is a string of 20 days without a single drawdown day, without a single loss day. Okay, let me look at the trade journal and get into that mindset. And just reading a trade journal is kind of like hearing an old song from your when you were a toddler or something. It just brings something back in your mind. It puts you in that zone. And that's a key thing about keeping track of these things. So yes, I'm very, very statistics-based, very, very log-based. You really need to, that's part of the prep, is to keep a log. And one last thing, and I've given talks about this to FIO that were really well attended, actually, talking about trade logs and so on. I talked about, how do you grow when you don't know where you are? When all you're measuring is your P&L. Hey, look, last month I made $5,000. This month I'm going to double it and make $10,000. But if you don't know, if you don't recognize that the $5,000, 40% of it, $2,000 of it was made on a trade that happened to be lucky. You happened to get in with the maximum size by luck before a big break happened. How do you replicate that? With a trade log, with statistics, which is what we're talking about here, you can set those goals realistically. You can see what is an outlier and take it out of the equation and look at what is in that, what is in what we call normal, the first standard deviation, the first sigma of your performance. And in that way, you can then come back and say, okay, next week I want my expectancy is two ticks net, net of all costs, losses, and everything else. I'm going to go for a 3-tick expectancy, and that's, now you're basing it on something realistic. But what that does is it causes you to be choosing. It causes you to see how freaking expensive the your losses can be. You could chug along and make $100 here, $50, or lose $20 here, make a $500 and have a breakout day, and then lose $100. And then one day you decide, I'm going to pile on to this trade. I normally trade 1 or 2 lots, and then here you are, you're in an 8 lot and you're taking a loss. and then you're dealing with all the emotion, you're so tied up with your emotional stuff that you actually, when you close that trade, you kind of immediately move on because it's painful. But what you don't recognize is when you go back later and put it in your trade log, you'll notice that it just completely distorts your past statistics. And based on those statistics, it'll take you 18 days. If you get back on track, it'll take you like 18 days to make up for that one stupid ass trade where you removed your stop and you doubled down and did all this nonsense. And trust me, I've been in that position countless times before I learned not to do it because I'm stubborn. And so this trade log helps you kind of see it empirically that this does not pay. That kind of behavior does not pay. And what is the impact of a big loss? And because you've set a goal, now you're going to be much more of a professional the following week because there's a specific goal you're trying to hit. And you're not going to attain that goal if you just take scalps. Scalp for 2 ticks here and there. You're going to be looking to be more selective. The drive to do something while the market is doing versus the drive of waiting for a trade to just kind of bubble up to the surface that you're supposed to take, that drive is overwhelming in most traders. And having a trade log helps you to just stay calm and understand that all of this other stuff is fluff. I can't take those trades. I got to wait for my trade. And that's another benefit to a trade log. If you're not doing one, if you're one of the people who's saying no, that's okay. And you can keep going as you're going. But once you get serious about making a turn, once you get serious about wanting to see better results, it doesn't guarantee it. And by the way, derivatives trading is not suitable for everybody here. Once you see that these things are things that you have to do, and you become serious about it, the trade log is your best friend. Your trade log will become your mentor that you're searching for outside of yourself, okay? I'll try to keep my other answers shorter than that.
Okay, let's see what else we have. In your opinion, what is the best contract to trade during the overnight session? My goal is to trade full time, but right now I'm only able to trade after the New York close. Also, do you feel that daily pivot ranges are valid since there's little floor trading?
What contract to trade? So the answer to that, unfortunately, is not straightforward. It really depends. I would say the Asian session, everything from about 7 till when the European markets open, 7 or 8 o'clock Eastern till the European markets open, which is 2 o'clock for the treasuries in Europe and 3 o'clock a.m. for Eastern time for the indices. That period is tough. On most days, I would say 8 out of 10 trades, 8 out of 10 days maybe, and not much is going on there. What should you trade? If you traded the more active period, probably you should probably stick with something that is a little more liquid. I know many people trade the ES overnight and so on, but there's the Nikkei, there's on the CME, there are a bunch of different products. I cut my teeth in futures on Eurex products, so that's where I'll probably go, probably the Eurostoxx 50. The Bund tends to move a lot and then just die for months because it's a fundamental product. But I'd go with like the Eurostoxx 50 or something like that. If not, then it would have to be some sort of an energy. The problem with energies is that they're, the mini crude is not a very good contract. The micro is dead on arrival. It seems with the CME, they just kind of stopped working on that. And trading the crude requires really some a pretty sizable account to avoid the risk of ruin. So I would stick with probably a European product, probably the Eurostoxx 50 on Eurex. That is the equivalent of, it has kind of the same liquidity and characteristics as the S&P 500. As far as when you should trade, I know that folks want to kind of come home and trade in the evening. Now, it depends what time zone you're in. But I would encourage you to not do the Asian session, but instead do the European session. But it doesn't mean you should wake up at 1 a.m. and prepare. What you might want to consider is trading early instead of trading after work. Wake up fresh, get up early in the morning, and put in the hours early. Like you might have a pretty decent opportunity at seeing some movement between approximately 5 a.m. Eastern U.S. time and about the time it opens till about 9:30 a.m. somewhere in there. The Treasury's open at 7:20 Central, 8:20 Eastern. There are numbers that come out at 8:30 Eastern in the morning. I find like there's much more substance to the movement and more liquidity at that point. So I would probably shift to say, okay, instead of staying up late and trading, I would say get up early and trade and get that done early in the day. Come up, wake up fresh, do your stuff and do your homework and get going. That's what I would recommend.
Okay. Can you briefly outline how you determine and manage risk control on longer trades? Or I'm going to add to this, or do you approach risk for the trade the same, whether it's short term or long term?
Not sure I understand. So how to determine and manage risk on longer trades?
Yes. And then my add to is that is the way you manage risk the same, whether it's a short-term scalp or a long-term trade?
So one thing I avoid doing is to speak out of turn. I know quite a bit about futures. I've been doing this this year. It'll be my 20th year, and I've traded a lot. And what I don't do though is I don't trade long term. I'm not a swing trader or anything like that. There are instances where maybe a trade starts out as a structured trade, which is intended for 15, 20 minutes or maybe an hour, that turns into a day-long, runner or something like that. But I don't think I've ever held a position overnight or for more than one session. So I want to disqualify myself as someone who should answer that trade just because I just don't want to mislead you. In terms of managing risk, I can only address a portion of that question. How do you manage risk differently for a scalp than a longer term trade? I did this talk at Convergent Trading about risk management in the fall of last year, and in it we did this spreadsheet that randomizes long or short trades and randomizes the probability of win or loss. It's completely random. I believe the sample size was 5,000 trades. And what you do is you tell it the target versus the stop, and so you automatically have this R factor. And the biggest component, you sit here and you hit F9, F9, F9 in Excel, and it creates an equity curve and tells you a lot about what this randomization looks like. And it's quite valid. It's a classic Monte Carlo simulation. But the biggest thing that that affects the equity curve, even with drawdowns, is the R factor. So whether it's a scalp or it's a swing trade or whatever, if you're sitting here working on a risk factor of 1, meaning your target is equal to your risk, or a risk factor just slightly over 1, the burden of overcoming the random nature of the market, the randomization of the market, and the market is truly random. There's a heavy hand in luck in trading, but there's also a tendency in the market. And so the best way to overcome that randomization is to improve your R factor. Does it have to be 3 to 1? Some swing traders look for 6 to 1 or 10 to 1 trades. I I've never been involved in a trade that was structured and turned out to be that way. I know it gets done, but the biggest thing when you're managing risk is to not sit there and cause your risk to be outsized versus the potential profit on the trade. This seems very simple, but if I was to run statistics on all traders that are listening here today, I will find that most of you, that most people, well, let's just make it a general population question. For most people, you're working with a 1-to-1 with about a 35% win rate historically. And I've done this on live data, a study on live data in the past on several hundred accounts, live accounts, and it's the reality of the situation. It's hard for people to let that winner kind of run. So what a lot of people do is they say, okay, I'm going to use a 2.5 point stop, and then the market moves 2 points or 3 points, starts wiggling, and then they just close the trade. They're like, okay, at least I covered the loss, so I'm doing okay. But over a large sample of data, you know, putting in 2.5 points of risk, and I'm not saying that's an appropriate stop size because that's a function of your time frame. For most people, 2.5 points of risk, and then you go and you take the trade off for 2 points or 2.5 points. If you do that 5,000 times, you will be negative. You will not be able to cover your risk, in my opinion. So you want to manage risk. The first thing you got to think of is, how much am I willing to push on the table? Think in poker terms. How many chips am I willing to push onto the table just to find out if the next cards that I'm dealt are good enough to play? Now that's called the ante. Your ante is your stop. That's the minimum you're willing to bet in order to see the cards on the table. And for most people, what happens if we're watching poker is they start with an ante, they have full intention to double that ante, and they get these cards, you know, they get a 4-6 or some crappy thing, and then they just start, you know, they bet a little too heavy, and they're like, well, I'm in the pot anyway, and I can't afford to lose all the chips that I bet, so I'm just going to keep betting no matter what anybody else is holding. That's how people generally trade. And in poker, you'll last maybe 3 rounds before it's done, and that's why we see these people kind of blow out and have to refund their account. So risk reward is really a huge factor. And then once you've got that figured out, don't take a trade that you don't think you're going to get your target to offset the risk, and the target has to be bigger than the risk. It has to be in most cases. That's the easier way to make money, in my opinion. But, you know, and once you figure that out, now it's about, you know, sizing the position and other fundamentals. Okay, so swing or scalp, don't trade for targets that are lower than your stop, because it takes so little to wipe away all those little profits with one big stop out. Okay.
That's actually perfectly segues into the next question. He says, you're finally consistently profitable week in, week out. What is the best way to increase your size of contract traded? Dollar amount, contract, risk-based, or anything else?
That's my favorite question. It just means that the person's actually done the work, and that we're seeing some success, which is great. The best way to increase size is very incrementally. So what you would do is, I'll tell you the way we used to do it in prop. In prop, let's say, you know, I wanted everybody to trade more than one lot. One lot trading is generally not profitable, even for a person who's been kind of under monitoring and mentoring, and it's really hard to profit that way. That's why I was a huge advocate for the micros since 2012. You want to trade multiple contracts because you want to skew risk in your direction. In other words, you want to get in with 2 with a stop sized enough that you're not going to get hit on a full stop often. Usually you want to be around 30% full stop on your trades. Take a portion of the trade off, and then go for your go for that target with the second because you funded a portion or all of the stop at that point. That's kind of the easier way to do it. And what we would do when somebody wants to grow is we say, you're going to come in and you're going to do the normal thing. If you're trading a 2-lot in the DAX, Eurostocks, Bund, S&P, whatever it is, crude, do your normal thing. Build up credit for that next contract. So 1 or 2 trades. Hey, I have a base of $300 right now. Okay, go ahead and up your size. You only add 1. You only add 1. The most prudent way to grow is to just add 1 and make the move to a higher size as imperceptible as possible, as benign as possible. And what happens is you add that 1 and it doesn't really affect anything because you have the confidence already. You kind of made a little bit of money during that day, so you're in alignment with the market at that point, and that third contract really starts to work for you, hopefully. On an individual basis, I would not do that though until you're able to have be properly margined for that additional contract. So just because you've had 2 good days, you're in the micros maybe trading 2 lots and you've had a couple of good days, you put up $200 and you feel really good and you're just dying to add a third, or even, for most people, they just want to go to 5 right away. Unless you have enough to monetize the next contract, meaning if you've been trading with 50% of margin, you need to earn that additional 50% of margin in your account before you move up. And what that does is it prevents you from growing too fast, but also statistically keeps your risk of ruin, your sizing risk constant. You want to keep that constant so that if you happen to hit a drawdown, as soon as you add that third contract, it is not having a huge impact and you'll just fall back to 2 lots right away, drop to 1 lots if you have to at some point. And what controls that is the margin. What is the required margin? Because margin is a direct correlation to, that's the exchange is simply looking at what is the most damage that can be caused by 1 contract on a given day. And they look like, I think they look at a 6 standard deviation move or something like that historically, and that's how the exchange determines margins. So margins are really a good idea of what you're getting into when it comes to how to manage risk, and you don't want to add too quickly. Most people, they trade a 2-lot in the micros, they make a little bit of money, and now they want to go trade a 1-lot in the ES. Well, that's a big jump because 2 lots in a micro, 1 lot in the ES, that's going from 2 to 10, and you don't have the ability to take risk off. You're kind of punching yourself in the face twice there. So make it gradual. Just remember, your goal is not to pay the rent. Your goal is not going to be to pay the rent for at least a couple of years. Your goal is to be absolute about and I'm using the word absolute, okay, very important, to be absolute about your execution. That's what's important. If you're absolute about your execution and your plan, then you have the confidence and the trust in yourself to do what's required to get yourself out of trouble. You know that you don't need to confirm and then double confirm and then triple confirm a move before entering. You're kind of just executing. That's where you want to be. The fight here is not to make money. I know it's all about making money when it comes to trading, but that's misleading. The fight here is about perfect execution. It is about being in the flow and just really aligning yourself with what's happening in the market. Once you have that alignment, it becomes easier then to increase your size. And when you do increase your size, you don't want to be trading going from a 3-lot to a 30-lot before you discover that you've got some issues to work out when you're at a 30-lot, because then probably your broker's taking you out. You're not taking yourself out. You want to make it gradual and discover at what point. It's kind of like adding weights to a bench press at the gym. You don't want to sit here and go, okay, I'm great. I'm doing, 4 sets of 10 on a 50-pound load. Okay, I see a guy over there doing 300 pounds. throw on the plates. Let's get it off the rack and see what happens. Well, it'll crush your neck. It'll crush your ribs as it comes down. You want to add incrementally and find out where your form starts to fail. Find out what you need to do to support that weight, right? And it's like a Kaizen principle, like Toyota does with their manufacturing process. You speed up the conveyor belt a little bit by adding one more contract and find out where the shaky parts are. And then those become your focused practice. Those are going to be your dedicated things that you have to work on. And then once you've worked that out and becomes something you don't have to deal with, you add another contract. Oh, no change here. Add another contract once you've made enough money to cover margin, and that's how you grow. That's how you grow reasonably. And at the end of the day, if you're doing this professionally, as long as the market can take it and your account size is appropriate for the risk, trading a 300 lot, well, now it's so much thinner, but in ES, trading maybe a 60 lot or a 6 lot to that product isn't all that different. You'll get filled. You won't get filled completely every time on a 60 lot, but it shouldn't be that different to you. It shouldn't matter because you're just in the flow. Okay.
How do you handle when the market does something completely different than your expectations for pre-market analysis? Do you end up not trading that day?
No, you don't have to sit out just because the market didn't do what we anticipated. Actually, what we anticipate is only a piece of the puzzle. This brings me back to the Monty Hall problem. You might want to look that up, the Monty Hall question. It's kind of a riddle. If I come in expecting, like yesterday, in yesterday's Trader Bite, I expected a pullback, a push down in the ES, and a push through the high and a continuation up. Given how it behaved in the prior session and overnight, I expected it to continue. And what it did is it opened, dropped, tried to push higher, and it just dropped some more. And what that tells me is not that I'm wrong, because it doesn't matter. My goal is not to be right. My goal is not to come in and be right. What it tells me is that the market is not able to continue in the context of where it's going. Imagine a rocket that you've calibrated and aimed, and the rocket is supposed to land, 50 yards down in this one area. And as soon as it launches, you see that it's gone too steep or the angle's not right. It doesn't mean that the experiment has failed. It just means your expectations now need to change. You know that, hey, there's an adjustment. There's something really important that I'm learning from this little experiment. And so what it does technically, I'm not advocating for this, what it does is it gives you a lot more confidence in the other direction. If the market is expected to go down, and it pokes through yesterday's low, and then you see the size come in and rip the thing up, then I am much more confident getting long. My longs are much more confident, even though my plan that morning was to sell pullbacks because the higher probability player, the big trade of the day, is likely to be short going in this direction. If it pokes down and I see the size come in and rip up, and the selling dries up as soon as it takes out the prior day's low, then the long is going to be a whole lot more confident. Not only that, but those people who are slow to on the uptake and don't allow for that in their plan, they're the ones who are going to be selling and covering higher, selling and covering higher, selling and covering higher, and getting frustrated. So when the plan does not work, that's a good thing. It's an additional indicator, and it's probably your most accurate real-time indicator that's taking place. Anyway, I'll do my best to keep my answers short going forward. It's hard.
All right. There was a question. Let's see. Can you expand on your harmonic rotation concept, or can you point us in the direction of a resource where you can take a better look and understanding it?
So for that, I would go to YouTube and I would do a search under, just type FuturesIO, and then harmonic rotations, and you'll be sent to a video I did maybe in 2014 or something for Futures IO, and it talks about harmonic rotations. What harmonic rotations are, in a very simple sense, is there is a normal ebb and flow, kind of like your blood pressure. There's a range in which your blood pressure is normal. And what we want to know what that range is. If I were a doctor, I would want to know what that range is. And when the market is outside of that range, when it's kind of expanding, I know that something, it's one of the earliest indications, it's one of the earliest indications that something is not normal, that there's some behavior that is causing the market not to be within those normal bands. A harmonic rotation is the first standard deviation, or what we would consider normal, or about 70% of the data set. When we look at 20 days of rotations on 1 minute bars or whatever minute bars you want, you get this ebb and flow that is normal. The market has a kind of an ebb and flow, kind of like the tide coming in and going out, coming in and going out. And then when it's outside of those bands, now we can start looking for, okay, what's pushing? Why are the rotations up expanding much more than the rotations down? Do I want to be short? No, I don't. I want to be looking for pullbacks to get long. It's not lagging. There is no moving average. I'm not relying on moving averages or CCIs or anything like that, or any lagging indicators. I'm looking right at the rotation and I'm judging the behavior based on rotations. But there's a video on that.
Okay. How do you close a winner? How do you close a loser? Are you using trailing stops, or do you aim at hitting a specific target?
Like everything else, none of my answers are going to be simple, but you know, closing a winner is really, if you're able to trade multiple contracts, which in many cases you are, really the trade, you know, I shared with you last year before the micros came out. I came on Futures IO and did a webinar on the micros, and in it I shared a plan for trading the micros with a 3-lot, and I said the first lot scale out is intended to skew your risk and fund a portion of the trade. The second lot is your target. That's your wish point. That's the price you need to get to cover the overall risk on all 3 lots. And then that leaves you with one, and that is a runner. And so I'm using multiple methodologies here. I'm using, you know, getting in, getting out, getting in, getting a target. And then the last lot is almost like a getting in and a trailing. But I'm trailing using market structure on a short time frame chart. You can even use like a point and figure chart or something. And as the market kind of consolidates in small waves and continues to break in your direction, let's say it's long, I'm looking at that last consolidation as my defense. It's like the last trench. As we push up the field of battle, that becomes the last trench that I can kind of hide in to protect myself in case the enemy comes back or the opposing force comes back. And so if it comes back to that last consolidation before the last break, and that consolidation doesn't hold, close the position. Just like you, even though I've been doing this for 20 years, I understand how the mind works, and I understand that while a position's open, there is some level of stress or commitment on my part to the trade, and as a result, I cannot consider myself to be objective about the trade. So even though it might pull back and I close the trade and it continues for another 30 points, I know that I need to clear the slate and look for the next trade, as opposed to sitting here and thinking that I can objectively manage, manually manage a trailing stop. And I don't use like an ATR stop or volatility stop or anything like that. I just don't use that sort of thing. I'm always active in the trade. I don't put in stops and just sit there and watch them. I'm constantly watching how the auction is going and how the rotations are behaving.
Okay. For your rotation study, do you change any of the settings when the range expands, or is it always consistent? On Sierra chart, I find I have to change my zigzag settings to match your fractal rotations.
Yeah, you have to change. You have to adapt with volatility. So I have this thing called the fractal rotation chart. I run it usually once a week. If not, when the market kind of starts to change, I will adjust the look back period to 10 days versus 20 days. And I have to adjust. And it would be silly of me to go from the 2015 market where the days range is like 9 points and trade with a stop that's sized for that kind of range, 2.5 points, and go and trade that in the middle of March on this big sell-off where the rotations were like 22 points in March. That's how wide your stop had to be in ES not to be in noise. 22 points. That's more than twice the normal, the historical days range. So I'm constantly adjusting those, and I check those pretty much every Sunday night when I'm prepping for the week.
Okay. He says on mindset, what tools do you use to keep your focus? Books, philosophies, heroes?
I would say the biggest thing is meditation, just being able to find your center and keep your center. I'll give you this example, and I've done quite a few mindset type talks here at Futures.io because it's a huge piece, as you may have guessed. If you're someone who gets easily perturbed, if you're someone that you've been told again and again that you have an anger management issue, or you're just angry or aggressive, trading is going to be one hell of a teacher. One hell of a teacher, because the thing that gets us there, the real big traders and the big opportunities are for those who are able to just stay with it. So if you find yourself easily perturbed or very responsive, then you are someone who is very easy to cause to react. Like you're giving the person, people around you, or the situations or circumstances around you so much power because it takes so little to push you over the edge. And trading is really, really incompatible with that. So you need to be someone who's very centered. Even when things aren't going your way, you need to be able to be aware of your emotional state, the heartache you're getting, the lump in your throat. Be aware, just say, yeah, I hear you, I see you're there, and just not have to respond. Because for most people, they get that and they just want to fight or flight. They want to put on more size. They want to hammer on the market. They want to beat the market up. Good luck with that. It's huge. You cannot beat it. It's best to just align with it. So meditation has been great in doing that. Meditation, if you're someone who has a lot of, who's religious, your faith, being able to pray or being able to just go inwards, that's the biggest, by far, the biggest thing to learn. Ray Dalio, who ran the biggest hedge fund in the world, is a transcendental meditator, and he used to do it all the time, and look where he went. You need that kind of center and that stability as a trader, because the market is just there with a needle just poking at you from all different directions while you have a blindfold on. It'll drive you nuts. So it's best to just stay calm, stick to your plan, and do what you need to do in order to have that.
Okay, there's two questions. One's on HFTs and the other one is on AI. I'm trying to combine these the best I can.
Sure.
How do you think that HFTs and AIs have changed futures over the past few years? And what role do you see for humans in, say, the next 10 years coming with these technologies influencing trading more and more?
So technology does what technology does, and that is an extremely efficient and very, very high speed execution of a set of instructions. Those set of instructions were created by a human being. And those set of instructions take in inputs, variables, and things like that based on actions taken by other human beings. In a world that is governed by HFT, in a most efficient, AI-based or algo-based market, give me your guess, those guys listening still. Give me your guess. What would the trade be like if it was 100% HFT and no human beings? What do you think would happen when the market opens? Exactly. No movement. The market thinks we should be at 3203.50. Boom, that's the next print. Done. It's efficient. It's done its thing. No, it wouldn't be limit up. It would just go to that price. And that's not how things work. So yes, a huge amount of the trades that go off are not click trades, are not human trades, they're computerized trades. But what it doesn't tell you, what's not being reported, is that there are human beings that are deciding what the system should do. So the system is executing a plan, but that plan is based on human ideas of what the future holds in today's prices and how to get an edge out of those future ideas. AI can generate all kinds of models, but these models are, pardon the term, shit in, shit out, right? If you have given good information, they give you good information, but it's all based on probabilities, and probabilities have a random factor that even a computer cannot overcome. Nothing can overcome it. Random events are random events. They've been here since the Big Bang, and they'll continue to be here well after. So human beings are not going to get replaced in the marketplace, and if they do, we do what we do best as human beings. We go and create a new exchange that does not allow computers, and that's what we'll do as human beings. There's not going to be a Terminator world here in the next 10 years where you and I are obsolete. The volume that's being traded by electronics, by electronic trading and algos and things like that, HFT, those are systems that are there to execute large orders in a hidden way, icebergs, MIT trades, things like that. But they are not really deciding what the fundamental outlook of the market is. There's somebody looking at it and deciding, yes, model number 322 looks most realistic. This is the one that we'll send to the trade desk. The trade desk decides what to execute, what system, what algorithm is used to execute it. The trade desk is required to report that a computer is executing that order, which was generated by a human being, and off to the races we go. And then there's all these machines that see that order flow and respond to it, but they are responsive. If there's no movement, then we'll just go to one price and we'll just stop. The whole day will be just a 2-tick trade. So that's what an efficient market is if you keep piling more and more machines without human beings on it.
Okay. It says, for someone teaching themselves futures, how long on average to turn the corner to consistency, if they make it at all? Thanks.
If you're someone teaching yourself how to fly an airplane, how long would it take for you to learn how to become a pilot if you learned it yourself? That's basically the same kind of question. I'm not trying to be facetious, but the factors that tie into it are so variable. How dedicated are you? What company do you keep? What are your sources of information? Are you identifying your errors and performing deliberate, focused practice on those errors on a daily basis? Are you setting goals? What's your mindset like? What kind of a personality do you have? How much money do you have? What financial pressures do you have? How much support do you have? It's just so huge. But if I was to lump everybody and come up with some sort of an average, where an average hardly ever describes what's really behind it, but I would say somebody who's doing this online, even with good sources of information, supported by a community that is dedicated to traders, you're looking at a minimum of 2 years just to move from stage one, the first stage of competence to the second stage of competence, where you're like, yeah, this is not that easy. It's not as simple as clicking and making money. There's more to it. It takes a couple of years to really know that at the cellular level. And then to move to the third stage of competence, where you're actually executing and there's a methodical approach to what you're doing, could take another 3 years or something, depending on how stubborn a person you are or how likely you are to accept the truth about the markets. But then you take someone else, like the guys I used to back, right out of University of Illinois here, or DePaul or something, and you sit them down and you say, this is what you're doing today. Today you're going to be putting on a one lot in the Dow, and you're going to be scratching it all day. You're not going to try to make money. You're going to be putting it on and scratching it all day long. And then tomorrow we're going to do this, and then we're going to talk about why did you do this. We're going to look at your analysis, your analytics. And it just becomes like, learning to be a professional football player by just finding a football and going out to a field and running around, versus learning to be a professional football player and you have a dedicated coach and a nutritionist and a therapist and a masseuse or a masseur and all of this stuff. It's such a huge variable, but it can be done. It's not suitable for all, but it can be done, but it requires a lot. Trading is going to teach you who you really are, because there's no way to hide from the outcomes when it comes to trading. It really is, you can't fudge your way through as a trader. So you have to be really 100% dedicated to it,
Okay, we are long on time, so I'm going to make this the last question.
Give me a juicy one.
I got two.
Tough one.
I'm trying to see if I can combine them because they're somewhat similar, but not. He says, how do you handle the transition as a day trader from a directional market to a balanced market and not get caught up in these shallow rotations?
So the market operates in time frames. So within even a trend day like today, we had a big trend day down. Even within that, in a short time frame, there are scalpable regions in both directions. So there's no trend there for a period of time, right? The thing is, this is kind of an interesting thing that people don't talk about in our business and our industry. But here's the thing: with trading, you're given this huge canvas, okay, big blank canvas, and you're given, you can go to your broker, hopefully to my brokerage, and you go to your broker and they'll set you up with a trading platform and whatever services they provide. It's like me showing up with a few cans of paint and some paintbrushes and saying, have at it, go have at it. And there's nothing on the wall to color. You just don't know what to do. And so you have to kind of look around the room and see, okay, that guy is doing this lady over here is doing that. And you have to kind of mimic, because there's no path. Whereas with most other disciplines like engineering, medicine, law, philosophy, there's a path, there's some curriculum. Trading does not have that, because with trading, it's really a freestyle thing. And the more freestyle it is, the more profitable potentially it is. You don't want to do what everybody else is doing, because then the edge is blunted, right? That's just a fact. But what we have to do as part of this painting process that most people don't talk about is you take this huge canvas, and what you have to do is you have to tell yourself, look, I can go in a billion directions with this and it'll turn out ugly. But what I could at least do is identify and box in sections of this canvas for certain aspects. And that's the part about trading that is hard to kind of wrap our heads around, is, hey, how do we transition from a directional market to a balanced market? And then again, when it breaks, it's it's hard to do that without first saying, look, I'm not a swing trader, I'm not an investor, I'm not a scalper, but I need structure. I'm going to trade off a structure, and I'm going to run some basic statistics, and I'm going to do some walk forward testing, keep track, keep an analysis, and so on and so forth on these particular things. Yes, there are 120 different ways on Futures.io that I can follow journals and learn from all these people. I don't even know if they're making money or not, but they're all cutting the market in 60 different ways, and I'm going to try all of them. With that, you'll lose 10 years of your life and not get anywhere. What you have to do is decide what makes sense to me and really limit. And I call that sandboxing, like just create it's a big field of sand. You're going to take, a 2x4 or 2x6 and just make a box and tell yourself, I'm going to play with the sand in this box only. And until it proves itself to be unworthy of my time or impossibly profitable, then I'm going to pick up my 2x4s, my plywood, and go and put a box somewhere else. So I have to decide, am I trading equity indices? Am I trading stocks? Am I trading Forex? Okay, if I'm trading futures, am I going to do energies, or am I going to do treasuries, or I'm going to go back to indices? If I'm trading indices, do I need something that's a little more liquid that may not move a lot, but has more price stability, a more thorough auction or more logical auction? Or do I go to something like the Russell, where it's just whipping everywhere, or the NASDAQ even, or the DAX, where you need like $42,000 per contract margin? Then okay, once I've decided that this product feels like it's something that I want to explore because it kind of makes sense to me, I like the way it moves around or whatever, okay, what is my time frame? Now I can't listen to that guy who's telling me that the market's going to rally, because that person may be looking at a 60-minute chart, and I'm here working off of a 1-minute chart trying to get long in a pullback. You need to kind of constrain. There's so much information, this huge blank canvas. The first thing you got to do is take a little marker and just cut off certain areas and draw in what you want to paint, and really limit yourself initially to that. And don't change just because somebody came on and said, I made $23,000 today. What did you do? Yay, here's my statement. Doesn't mean you drop what you're doing and you go to them, because then you're just seeing the tip of the iceberg. To get to making $23,000 that day, that person has spent $200,000 of their life putting that together. So you have to do your own thing. You have to make it your own. The good news is, through FinTwit, through Futures.io, through many different outlets, there's a lot of information where you can just pick off a few things, but at the end of the day, you have to make it your own. It's your canvas, it's going to be your painting. What do you want to draw on there? What colors do you want to use? You have to box it in. Otherwise, you'll be lost. Like if you tried to follow me, you're going to be lost, because I'll come in saying, yeah, things look long today, I'm going to look to buy pullbacks, and next thing you know, I'm just scalping short. Well, I'm scalping in a very, very short time frame as we work to the area where I want to get long on a structured long. You don't know that. You're just going, well, this guy's an idiot. He's saying he's going to get long, yet here he is taking shorts, right? I've had my own traders say that to me. Well, you're contradicting yourself. No, I'm not. Just trading in multiple time frames. You trade in one time frame. So as you decide, how do you make that transition from of what? Look at your particular chart and remove anything that's not important to your decision-making process. Look at your particular thing that you want to look at and learn that thing. Learn that MFer that you're looking at. That if your chart is a point and figure chart with 2 moving averages, you better be the best point and figure chart with 2 moving averages guy on the planet. That's what it takes. You have to figure out what it is you have to be the master of that thing. You want to add another line to that chart. You want to put on a trend line. Are you going to execute off of it? Is it going to inform your execution? If not, don't add it. But if you do, you better be the foremost expert, world global expert in that trend line with the 2 moving averages on a PNF chart. That's what it takes. That's what it takes. Anything short of that, you're just dabbling. And that's okay, because it's very interesting. It's like a game of 4D chess, figuring out the market. But if you want to turn this into a career, which is what my focus is with the companies that I've started and all this stuff, is to address the needs of those people who are just wanting to turn this into a career, professional thing and have spent too much time dabbling around, okay? I know that's another long answer, but we've had some really tremendous questions today. And as always, I appreciate being here, and thanks, Terry, for inviting me on.
Absolutely. Thank you for the webinar and information and for spending some time with us this evening.
Cheers, everyone. If you need to catch me, you can find me on Twitter, FuturesTrader71, just twitter.com/FuturesTrader71. My website's kind of dead because my focus is on 2 other companies, Convergent Trading and EdgeClear. But you can find me at Convergent Trading, or you can find me at EdgeClear, whichever one. If you want to send an email, just go to the contact page and just say this is for FT71, and it'll make its way to me. So if I can help you, I'd love to. But in the meantime, watch your risk, take your time, and learn something every day. Learn something every day in the market. It's teaching us all something. So make sure you walk away with new knowledge every single day that you come in and risk your time and your money on the market. Good luck, everyone.